Any stop? Any stop?
Stephanie, can you hear me?
I can hear you. Can you hear me?
Yes, perfect. I was just trying to set everything up just to make sure. How are you doing so far?
So far, so good. How about yourself?
Not too bad, not too bad. Weather's a little cold over here, so trying to stay warm.
Where are you at?
Michigan.
Oh,
So
I guess I can't complain. I'm like, it's 50 over here. It's pretty cold.
I would love to have 50 degrees right now, but I think it's 40 degrees right now, if I'm not mistaken, over here. So it's not
That's
that
not
bad.
too bad. At least you're like
Yeah.
not in the negatives.
True. Yeah. So last week, I believe we were in the single digits, so it was a
Oh
little rough for
no.
us over here, but we got through it.
Ugh, I could never.
Let's see what we have here.
And Jaden was answering questions. He's trying to get out. And then it was a half an hour of like.
Are you guys in California or
Yes.
Arizona?
California. Yeah.
Okay. Just want to make sure, is it just you and Tamara in this meeting?
I have no idea.
I just want to make sure. I know we got an email a couple days ago. I know Scott was the one who reached out to Jeff on this one, the
Yeah.
AE. So I just wanted to make sure as well. You're only
I
talking to me.
think there were a couple others that are going to join.
Oh, okay. I mean, yeah, I just see Scott.
Yeah, on this one, they're loan amount is 605,000. And the purchase price was 636,000.
All right, guys, we'll kick off in about 2 minutes. We're gonna go over variable income. And I also want to touch on the subject of FHA identity of interest, something that we have come
Appraisal
across.
came back 580. Yeah. The new construction, and they got all these options on there. Increasing,
How you doing, Scott?
How you doing, Tom? How you doing, Jeff?
Price from like 5 something to 6 something for all these options they've added up. Yeah, they're paying like.
I think he's connecting right now with audio from what it looks like.
Okay, Top, we're gonna kick off in about 2 minutes, if that's okay.
Yeah, of course.
Perfect. You have a room of probably 20 LOs right now. I'm sure about 5 or 10 more might be rolling in here. So
All right, sounds good. Sounds good.
thank you.
Yes, the whole purchase price for the option. That could like buy.
I'm totally.
I'm just confused.
There's Jeff.
Yeah, he saw that online.
Yeah, I'll just let the freezer know.
Top, what's up, brother?
How you doing? How you doing?
All right, man. What's up, Western Pioneer?
Western Pioneers in the house.
Oh, yeah, look at that. We got a full house. Looking good.
Michelle asked if you got her email.
I did. I just didn't have time to respond. I read it about 5 minutes ago.
Okay, awesome.
I'm going to call her after this.
Okay, since we got an underwriter here live, let's just go ahead and dive right into this. One of the main culprits this year, really on having issues has been variable income. And when we're calculating overtime or holiday pay or seeing how income's trending, and we're getting a lot of discrepancies, ultimately giving us a debt to income ratio issue, especially mid-file. So I think it's very important that we go over at least the fundamentals of variable income, what variable income is. And, you know, if you're not salary and you don't have 2 years, some cases 12 months, it can become some issues for us. So we want to just try to see if we can bulletproof it a little bit. So we have Top right here, who's actually been our senior underwriter for quite some time in our panel here. We got Jeff Glazier, our AE, our wonderful AE here. So guys, can we just kind of start explaining about variable income, maybe talk about some scenarios, and we'll kind of have a live Q&A if that's okay with everyone.
Yeah, of course. I'll kick it off. Just let me know if you guys can't hear me. I'll go a little louder on this one. But we have these pod meet and greets every single week or so where brokers, loan officers come through. So I always let them know it's a good indication to always do a little, double check on their pay stubs as well. So for variable income, it can be variable hours. It can also, you just look at 2 pay stubs. Ideally, you would ask for 2 pay stubs, 2-3 pay stubs, and you can see it from there if the hours do fluctuate as well. A little math that you could do just to make sure like the year to date also supports the income as well on this one. I don't have a scenario on hand on this one, but I'm going to send you guys a full detailed email as well. We have a couple guidance as well from UWM on how we do things as well. Maybe a little bit strict, but the key thing is at least they need to have at least 12 months. 12 months is very big on this one. You can't really trend the income within the 12-month range. There's positive factors that come to play as well. The thing is you want to make sure you have at least 2 years, but minimum 12 months. So if you're trying to calculate variable income off of 12 to 24 months, what are the positive factors that we have on file to help boost our case? So what, our investors are looking for is, from what I'm looking at here is, are they in the same line of work from the previous employer? Borrower has been at the current employer for 18 to 24 months. Unused income. So let's just say they have multiple incomes on their pay stubs. So you have base, commission, bonus as well, but we're only qualifying off of base and overtime. We have at least 12 months on file. So let's just say they worked for 14 months, but we're trying to find positive factors to use this income. Well, the positive factor is they've been in this line of work for 12 to 24 months. They have unused income as well. We're only using base and overtime. So there's commission as well that we're not using. So we can try to use that route instead. The most important part is the trends that we have to do as well. It's a little bit different than salary, where we can just use the hourly rate and, calculate off of that. When it comes to variable income, we're looking at the trends from year to year. So obviously around this time of year is probably the worst time because, it's new to the year of 2023. Sometimes they haven't got paid out yet. With overtime, for example. So we just need to make sure that we get like the necessary pay stuff to trend that income, because if it is a decreasing trend, we have to go off of the worst case scenario, which most of the time is we're going off the year to date. So if it is decreasing trend, we have to go off the most recent year to date. If it's increasing trend, we go off of previous year. So previous year would be 2022 and whatever we have this year for 2023 to calculate the income.
Tom,
you have a question?
Yeah, can I inject on that one? So
Yeah.
you say we have to go off the most conservative of either the average or year to date. So recently we came up with this, a scenario. In 2020, they were making 5,000 a month on overtime. 2021, they made 6,000 a month. We've only had one pay stub here in 2023 where they only made like 4,500 on overtime because they took some time off for baby care. We got cut at the knees and they said, oh, because January was low, we have to go off of that figure. We got cut about $2,000 in monthly income there. So at what point does it become year to date? Because that's not fair with just one pay stub. Now they got cut midway through. So that was just a live scenario that we encountered.
Yeah, of course. Another question in the back? Okay.
So basically, in 2020, he was making 5,000 a month overtime. 2021, it was making 6,000. In 2022, and then this year he just had one pay stub. It was cut short, but just because one pay stub was cut short, now they have to use that conservative figure.
Yeah, of course. So obviously things like this as well, we always have our credit policy team as well. They're the ones who we escalate up to, and they talk to Fannie and Freddie Mac as well. So ideally, things like this as well, if they have the history, for example, in this situation, I'm not sure in your situation, if they went up the chain that way as well and, got it fully escalated, because we've had cases where, here's the case, obviously in 2021, they made 5,000, 2022, 6,000, and we're all of a sudden trying to penalize them off of one pay stub. Obviously, we'll try to condition out, try to maximize that income to the best of our ability. Maybe we get another pay stub and we try to, trend it off of what they have this year. But at the same time, there's other routes that we can try to explore as well. Other cases that I've told my clients as well is that sometimes they made 5,000, 6,000 right for the past 2 years. We can always do a 24-month calculation as well. So you do 5,000 plus 6,000 divided by 24 months, try to calculate that way as well. That's another way that we can try to at least give them the income.
Even though we have a year to date, you can kind of turn your eye on the year to date because it's so early in the year. Is that why we won't have to use 23?
Yeah, so other routes that we've had, at least for credit policy, if we try to use a 24 months, or sometimes as well, we incorporate that as well. So we do the full 24 months, 2021. We have 2022. Let's just say the pay stub this year was through January 15th. So obviously they've only made 15 days of income so far. So we incorporate that as well to our calculation. So it would be, so the math would be 15 days. There's 31 days in January. So you do 15 divided by 31. That will give you the decimal point that you add on to the 24-month calculation that you already have. And you pretty much combine the year to date together. So you have the 2021 year to date, you have the 2022 year to date, you have the year to date for 2023, and you divide that by 24 and whatever, how many days it is for the 2023 that you have, which is 15 divided by 31.
Okay, so how would we bulletproof that? In this case, they were a firefighter. Out here in California, overtime is heavy during the summer months, but January, February, it's slower for them. So let's say they are seasonal workers, or they, in this case, are a firefighter. Most of the overtime comes during the summer months.
Yep.
So now come March time, it may look low year to date on variables. So we have to go off of that, or can we explain and see the bigger picture on how their actually overtime works?
Obviously, yeah, definitely cases like that too. Like that's why we would want to take a bigger dive and try to take a second look, because obviously different jobs are different. Like you said, firefighters, they make the bulk of their income is in the summertime. So are we really trying to penalize them at that point and not give them the full income at that point? If they have the history, for example, 2021, 2022, we can look at, let's just say maybe we can try to do a 24-month average instead of just going off the year to date. Because what if you get a pay stub, for example, they only made $200 of overtime. Now all of a sudden we have to do that amount and just give them barely like chump change pretty much for income. So that's we can try to evaluate and send it up to credit policy, try to see if we can take a different route as well, because obviously things like that, it's a lot different from case to case.
Scott, may I interject?
Yes.
Go ahead, Armin.
Hi, I'm the one that's dealing with this right now with the underwriter. It's been really frustrating. Essentially Scott knows most of the story, but pretty much they're averaging $5,000 a month in 2021, $6,000 a month, 2022 in overtime. So 60 and 72K a year just in overtime. Sunday or December, his son was born during escrow, so he took paternity time. And then in January, he took his vacation. What I was trying to tell the underwriter is, how can you penalize someone for 1 month when they have minimum 24 months of overtime? That's more indicative of what they're making. And so it's just, now she was asking me for a pay stub of the end of the year to see if that overtime income overlapped into January. In my mind, I'm like, it probably didn't. And I'm like, that shouldn't matter. You have a 24-month sample size. Why would you dock someone that's on variable overtime when you have 2 years of history for it? So what's the point of averaging 24 months if you're not going to do it? What's the point of having 2 years of overtime at that point?
Yeah, I understand. No, I agree with you on that one too. So like once you're done with this too, send me the loan number. Let me take a second look, because obviously we should at that point not penalize them if it's only 1 month, right? They have the history for it. It's not like these are COVID times anymore, but I'm just saying, like, we can take deeper dive just to see like what was really going on if they fully escalate the file as well. Because if that came to my desk, I would definitely take a second look just to make sure as well. Like, are we actually maximizing the income?
Definitely we're not. So yeah, I'll definitely send it over to you. I'll get your contact information from Scott, I'm assuming. So, and then
I'll send that over to you, Armin. So yeah, I'll send you Top's information so we can look at it. You and I will tap in on that scenario.
Thank you so much.
I was gonna reference the same thing now.
Okay, Rosie has a question.
Should we do like a letter of explanation, how we calculated the income and basically the scenario?
Great question. Would that help underwriting if, like, let's say in this situation, we would kind of include a cover letter to explain how our calculations and how we came up to it? Would that help senior underwriters in getting on the calculating?
Yeah, of course. Yeah, those cover letters are, in my eyes, are very important. Sometimes it helps us, actually underwrite, like, correctly on this one. Sometimes it might be a lot of REOs, incomes might be all over the place, but if you can give us a little bit of cover letter and, guide us a little bit, that definitely helps for sure. Variable income, it's been years, been here for 3 years. It's always a touchy topic, especially in the beginning of the year as well, with, variable income not really being dished out at all in the beginning of the year. Like, for example, the firefighter situation, they get more income in the middle of the year. So situation like that, we shouldn't be really penalizing them in that situation. So feel free, send over the loan number, especially for that one, Armin, and I'll take a second look and see what we can do and try to maximize that income as well. Because in my opinion, I feel like we didn't really fully look at that file and maybe escalate it all the way through to see what we can do for that one.
I did get a text message to another question. Does a WVOE always trump pay stubs?
No, not necessarily. So we always go off of most recent income docs. So, we go off of what you guys provide us, but if a pay stub was dated 1/10/2023 and a WVOE is dated, let's just say 1/5/2023, we're going off of the pay stubs. That's the most recent pay stub year-to-date information that we have. So we're always going to go off with the most recent one for sure. Sometimes you're going to have some issues with the VOI. If you go through the work number, sometimes the information on the VOI is a little bit incorrect. They're not pulling the correct dates. Sometimes it's so hard for us to, like, we can try to match it all up together. If we don't have the pay stub, it's really tough, but you could see on the pay stubs, it'll tell you the pay periods on there, exactly when they get paid out, what the pay periods are. The VOI doesn't really do that. It just has one date. So sometimes you're trending off that one date and we're actually not giving the correct information, qualifying them with the right income calculation. So VOIs are good to a certain point, but I believe the WVOEs and pay stubs are more accurate in this sense.
And one doesn't trump the other, it's just the most recent.
Yeah, most recent, yeah.
Perfect. Okay. As far as, let's say, overtime, sick pay, holiday pay, when do you determine if it's going to calculate over 12 or 24 months on those?
12 to 24. So those always do factor into the base pay. So whatever you have, holiday pay, you said PTO as well, all those are all counted as base. So if you see that on the pay stubs, those will be added onto your base income calculation, if that is what you're referring to.
Yeah, and then we could determine how the
Yep.
income trends, correct?
Yep, exactly. So those will always be added on to the base. So those are not overtime or other pay by any means. So whenever you see that PTO, sick pay, holiday pay, those are added on to the base. That goes for salary pay as well. When we do look low year to date, high year to date, those are added on to the base year to date calculations as well.
Even if you don't have 24 months?
No. You are
Mhm.
fine. We just added on to the base. That's totally fine. Because what if 1 year you didn't take any sick days off? Like, we're not asking for the history there. You just add it on to the base.
Perfect, okay. Rosie has a question.
Yes.
How do we calculate the income for nurses? Do we do it off the award letter or do we do it off the year to date if they haven't met their 2-year history?
Are you referring to like traveling nurse by chance, or because just regular nurse? It's a little difficult when it comes to nurse, because anyone in the medical field, sometimes their full time is a little bit different to everybody else. How we consider as a lender, and the majority of the lenders here, is 40 hours a week is considered full time. Nurses, medical field, doctors, whatever, they are usually considered 35 hours is their full time. How we calculate as full time on that one, or trying to push at least to tell all the brokers and loan officers, is that, are you able to verify like what their guaranteed hours are? Like maybe they're guaranteed 35 hours a week, 32 hours a week, and we try to calculate off of that. We'll do the math off of their rate, and we compare the year to date with the rate to see if that matches up. If it's a little bit lower, at that point, you kind of have an indication that this is variable income, and we try to combine all of their differentials as well, because sometimes as a nurse, that's just how they get paid. So you're just literally just trending off of the pay stubs pretty much from year to year, and that's how you get that qualifying income.
Yeah, only because for nursing, they have been getting a lot of overtime. So
Yeah.
I wanted to figure out with the medical field getting overtime, am I able to use that overtime?
Yep, you can. Yes, you can. So it'll be different though, because obviously base and overtime is two different trends on this one. So overtime, we would, sometimes they get overtime. It's a little bit weird it's hard to, case by case, but overtimes they'll have overtime 1 and overtime 2. It's all over the
Yeah.
place. If you look at any like nurse pay stub, they have so many pay types, but we're to the to the best of our ability, we'll try to at least match it up. Overtime with overtime, then we'll have base differentials, wherever the case may be, and we'll trend like base and differentials and together, and overtime with overtime.
So with nurses underneath like a year time without the 2 years, we could still consider their overtime if they have a year of overtime?
Yep. So as long as they have at least 12 full months of that, right? So for variable income, which is the one big thing that we can't really, trump. That's one thing that, both Fannie and Freddie are big on, is that you need to at least have 12 months. Due to the nature, it's a riskier pay type compared to salary. Salary, you're guaranteed a certain amount. Variable income, it's variable, so you don't know. You're subject to change. One pay stub, you might get $300. The next pay stub, you might not get any at all. So that's why, with the risk factor, we have to at least have 12 months history of them receiving the income.
Question.
Yes.
So say you have somebody that has not quite 12 months overtime history.
Yes.
But will have either at the time of closing or shortly thereafter. Is it taken into consideration, or is it a hard and fast that they will not accept the overtime if they haven't actually had it at the time of the underwriting?
No. Yeah, no. So if at the time of closing, we'll meet the 12-month period. Us as underwriters, there's a section where we have a must close by date. So we cannot close before this date because they don't meet the 12-month period. So we have to wait till that time period to meet the 12 months first, then we can close the loan. So they should relay the message to you as well. Like, maybe we are at 11 months, for example, and now at this point, we can't really close the loan yet, but at the same time, we're not going to deny the loan by any means, or we're not going to get that income. Let's wait for that 12-month period until we get full 12
But
months.
there's a little flexibility there.
Exactly.
And
100%. Yes.
there's a little flexibility there, yeah, because I mean, even if you had, because you're going to calculate it over 12 months anyway.
Exactly. So the thing is, if you have at least 12 months on that one, this is going back to, do they have any other positive factors as well? Because what they're looking for as Fannie and Freddie is that 24 months is the golden rule, but obviously, if it's 12 to 24, is there any other positive factors that we could try to add in? Is there any other pay types on that pay stub? Is there commission as well that we can try to add in? Oh, that's another pay type that we can add. That's a positive factor right there as well. Other
What
things,
what about a WVOE? Say if you got a WVE and then the VOE said that they were guaranteed overtime. It didn't
even,
quite-
yeah,
That
so
would be a compensating factor, am I correct?
that would be a factor, but at that point, so we're still going back to not meeting the 12 months. So even if they're guaranteed an amount, we need to make sure that it meets the 12-month period. So they can be guaranteed with like 9 months, but at the same time, they haven't meet the 12-month period just yet. So they have to meet that full 12-month period to actually even factor that income.
I also had another question on, let's say a borrower has had a 2-year history of variable income. And then, let's say took 6 months off and has been back on the job for 6 months. Are they out of luck until they're back on the job for 12 months, or can we actually go back to past employers and look at income trends?
Yes.
And gap out the dates?
Yeah, let me ask you. So you said they were gone for what kind of cause was it?
Maternity.
Maternity leave. Yeah, you can technically take that off of the calculation. You have the history for it as well, correct? Previously on this one?
Yes.
Yes, so I know, I think we still have that guidance too with our investors. If it's like COVID related, which is unfortunate, like we have to still trend the income as is. But if they're on maternity leave or actual leave like that, we're not really gonna penalize them by any means. So we just take whatever months they were gone by, and we just take that out of the calculation.
Even if it's 2 different employers?
2 different employers, so they left like in the middle of their employer, the previous employer, is that what you're saying? And they're
Correct.
yeah,
Yep.
that would be the same case because you're just taking that time off pretty much from the calculation.
Gotcha.
Yep. So-
Anyone on the Zoom have any questions with variable income, any scenarios you're coming across right now?
This might be a stupid question, but I kind of always assumed that bonus, commission, overtime, everything like that was always averaged over 24 months. But if I understand what you're saying, it's that it's year to date or averaged over 24 months, whatever is less.
Yeah, no, it depends on the trend. So if it's like increasing trend, declining trend. So if it's a declining trend, for example, let's just say you actually have a situation, going back to the firefighter. I know it was 5,000, 6,000, but let's just say it was 6,000 in 2022 and or 2021 and 2022, it's 5,000, for example. You have 12 full months at that point. You would go off of the most recent, so it would be 5,000 that you would have to trend. So increasing trend, you use the previous year, so prior year and the current year to date for the calculation. But the decreasing trend, you go off of the most recent year.
Got it.
Yeah.
I have a question.
Yes.
When would you year to date it at that point then? Like how many months would you year to date it? Like, let's say 6 months more pass by on overtime, let's say this year, right?
Yeah.
If it's does that be like 6 months upward in order for you to maybe year to date the overtime or go last 12 months, or how would you go about that?
Yeah, so like I meant, like I think your case might be a little bit different with the firefighter, but typically
Sure.
we would gauge it from the first couple of pay stubs to see like what's going on, at least to see that's going back to the credit policy as well, just to see if we assess the full risk of the file, to see if we can actually still do the 24 months. Ideally, once we're hitting the February, March area, like 2-3 months in, everything should be close to stabilizing a little bit, because obviously if you're getting overtime, bonus, whatever the case may be, let's just say bonus is paid out each pay stub or each month or so, it should stabilize at a certain point. So we're looking at 2-3 months and it should stabilize from there. We're not going to decline you or say no by any means, but we'll always, take a second look, escalate higher, go up to my division lead first. If he also disagrees, we can always go up to the highest level, which is the credit policy team, to see like if we actually can move forward with a 24-month calculation or not, or do we have to just go off of the year to date at this point, since the income at this point, 2-3 months into the year, they should stabilize by now.
No, what I'm saying is if it's increasing this year, would you
Yep.
just year to date it as well? And if it was the other way around as well?
Yeah. So you're saying if it's increasing this year already. So if let's just
Sure.
say it's increased, for example, yeah. So we'll just say at that point we'll just give them increasing trend. So we'll use the year to date in the previous year to trend the income.
Would you do that even by today, like in February, if someone's income was increasing on overtime, would you just go year to date at that point too, for if you have the 30-day pay stub?
Yep, of course. So obviously we're trying to at least try to maximize your income to the best of our abilities. But if it's decreasing trend, that's the part where we dig a little bit deeper, obviously. But if it
Yeah.
is increasing, yes, we're gonna give you guys the benefit of the doubt on this one and try to give you the most income on the file.
And last part, so essentially everything what you've said, there are so many compensating factors. Nothing seems to be really binary. It's essentially like you're saying, case by case, and all the factors, and you essentially make a decision based off of all the positive, negative factors, and essentially almost seems like if the positive outweighs the negative, you would proceed with it. Correct?
Yeah, so I think the toughest part, like I noted, was pretty much the earlier part of the year where we do escalate a little higher just to see, because it does, the income moves so much. It's so hard to gauge everything
Yes.
as well earlier in the year. So once the year, goes on, like that's more of is it decline or increasing? There's really no other way of, way looking at it. But if it is like early in the year, we're definitely going to take a deeper dive. If anything, if we can't get it done in underwriting, we can always send it up to credit policy. But our goal is trying to give you guys the most income as possible. So ideally, if you get a no from your senior underwriter, make sure you reach out to your team lead, or see if I can help you out at least to see if we at least like maximize everything on the file.
And last question. Sorry, I have a bunch, but this is important.
No, you're good.
If I'm looking at someone's pay stub biweekly and they have like 79.8 hours and then another one's 79.98 hours, like I have I think she's a medical assistant or something. She's on the pay stub or on the VO, it says average 40 hours. But when you look at the biweekly, it says like 79.8, 79.7. Could that just be a thing where they say it's 40 hours? It's essentially considered as 40 hours, even if the pay stub or the year to date might be off a few dollars. Is that a big deal?
Yeah, so that one at least, so I would avoid, I would look at your income docs first, right? So in your situation, your VOI is saying 40 hours on this one. Your pay stub is showing 79.8, 79.2. I would at that point just only upload the VOI at that point, because then you have contradicting information. It's only 79 and some change, but at that point, the underwriter will have to do their due diligence just to make sure that are they actually full time? Because you have two docs right now. You have pay stub that shows 79 hours. Then you have another another income documentation that shows 80 hours or 40 hours per week. I mean, like it's contradicting a little bit. Maybe it's a little less because maybe they are going through some sort of training that maybe or orientation. That's why it's a little bit less. You can always get some sort of explanation on file for that. But if you do see some sort of discrepancy, I would go with, at that point, if I was you, I would upload just a VOI so it doesn't cause any confusion or any added on conditions as well to the file.
So potentially I could probably still go based off a 40-hour schedule at that point.
Yeah, at that point. It's so close, but I know it's so nitpicky, but trust me, we do get these quite often, but at that point we always say like, man, they could have just uploaded the VOI and we will be okay, and everything supports. But if we have a pay stub, we send it to our investors, it shows 79.8, 79.2. They're a little skeptical, especially right now with everything. So we just need to make sure we're getting everything in line. So if there's something that's a little bit off, we're going to question it and we're going to add more conditions to the file. So if you want to do a little screening just to double check the income documents to make sure, I would just avoid those pay stubs, avoid the confusion, and just upload that VOI on file and you're fine.
Yeah, just make the case stronger too.
That was a good golden nugget right there, guys. Just to repeat, remember, look at your income docs. Once an underwriter sees something, they can't unsee it. So in that case, it could have been prevented where they didn't upload the pay stubs, just the VOI. So great one on that. Amy had a question. Amy.
Yeah, it was my understanding that 36 hours was considered full time. Is that Sandy?
No, yeah, it's 40 hours for a week. Obviously, like I said, for like in the medical field, sometimes it's 35, and it's been proven you can literally give us pay stubs. Sometimes it might not be the same, but if you have two pay stubs shows 35 a week, that's consistently in the year-to-date supports. That's totally fine. each employer is subject to how they get paid as well. Maybe 36 is full-time for that employer. We're not gonna really question it, but we will qualify then at 36 hours as full-time for that employer. If year-to-date supports, we have 2 pay stubs that show 36 hours. Yes, we're not gonna condition out for 40 hours on a pay stub or, you know, a VOE. At that point, it supports at 36. We have multiple pay stubs that show 36. We're going to go off of 36 hours as full-time.
Even if
So-
it's not in the medical field, even if it's not.
Yep. So obviously, if it's proven, for example, you have like 2, 3 pay stubs, they show 36 hours consistently, same pay and everything too. The manual math will come in. If their rate was 27, for example, $27 an hour, we go 27 times what, 36 times 52 and divide that by 12, and that will be your rate at that point instead of going to 40 hours.
Ulyss.
Yeah, so I have a couple questions real quick. One, I believe it was last year, like California passed legislation for nurses to like their full-time hours is a little bit less than like the federal standard is. I don't know how that, like, how we work into that scenario, but, so, and that kind of, like you said, if the employer considers, like, let's say 32 or 34.5, something like that, as a full-time, is that still considered full-time if they're showing that in that scenario? Or is it
Yeah.
30?
Yeah, so obviously there has to be some sort of cutoff as well, right? So we've had before, they said they were full-time at 24 hours.
The nurses.
They said that we've had cases where it's like
California
24.
had legislation passed would let them have, they could be considered full-time at a slightly lower hourly average. We ran into that in one of the files not too long ago.
Yeah, you said 32 hours, right? A week.
Yeah, I believe it's 32 hours is nurse full-time.
Yeah, of course, yeah. If you have like for that case, for example, if you had like multiple pay stubs consistently showing them that they were at 32 hours or more, at that point you have a case to build in year-to-date supports as well. But if you say, we've had cases like this too, that's why I'm mentioning this. They say, yeah, they're guaranteed 32 hours a week, but then you have pay stubs that show 28, 27, then 132.
Because they can't take time off. Unless it's, especially nurses specifically, if it's not busy, sometimes they'll say, hey, if someone wants to take some time off, they can leave early and it's not penalized, but obviously they don't get paid for it, but they're guaranteed those hours if they wanted them. So is that just one of those kind of scenarios where we just need to be really communicated with our borrowers and say, hey, like during the escrow here, let's really make sure that we have, you know, pay stubs that are showing your max hours.
Yep, I would do that. Yeah, for sure. I would make sure you relay that message because obviously maybe they are guaranteed, but at the same time, if you have multiple pay stubs that show otherwise, we have to question, is this actually variable income? Are they actually full-time at 32? Because it doesn't show that as well. They might say it's guaranteed 32. We believe you by any means, but if you show me a pay stub that shows less, then we have to go off, and the year-to-date doesn't really support as well, then we have to go off variable income at that point.
Real quick too, kind of going back on what Armin was saying, if it's trending up for year to date, do you use still the year to date and then up to the last 12 months, or is it just the year to date? So in other words, if you're trending up in March, you only use the last 3 months, or you use the last 12 and average it out?
Yeah, so if it's increasing trend, like you said in March, you'll use like whatever you have pay period. Let's just say like the pay stub you have is to the end of March of 2023. So you'll take whatever you have so far this year in March, so the past 2 months and a half or 3 full months, and the previous year of 2022, and that's going to be your trend. So you have 12 full months and end of March, so that'll be 3 months. So you'll take whatever the year to date was for 2022, whatever you have on that pay stub for the year to date, and divide it by 15 months.
I also had a question, is variable income calculated the same from Fannie to Freddie to FHA?
I can't speak to FHA. I can always reach out to one of my FHA team leads on this one. But for Fannie and Freddie, they are similar. Freddie Mac has this guidance where if there's a fluctuation of 10% or more, either way, increase or decrease, we get an explanation on file. Fannie Mae is a little bit more lenient. We still question increases and decreases, but not to the 10% threshold on this one. So it's a little bit nitpicky when it comes. What's that?
Yeah, we've ran into that Freddie Mac 10% threshold, whether it's trending up or down.
Yeah. So if you have a variable income, if you know it's variable income, ideally I would try to go route of Fannie Mae. Freddie Mac asks for a little bit more, explanation on file.
Scott, may I ask
It
one
cut
more
out on us.
question?
Yes.
Is it cool if I ask one more question?
Yeah, of course.
Okay, offer letter. If someone were, I had a situation where a client had an offer letter, but it was a 16-hour guaranteed job as a nurse. Would even a 16-hour work as like a part-time if it's verified by the employer and that's guaranteed? Part two of that question would be, what if it was a secondary job, or does it have to be primary in that case to only use that income?
Yeah, of course.
Season.
So are you trying to use like future income from what it sounds like? You have an offer letter?
Yes, exactly,
Yes,
exactly.
so this one, I'm telling you right now, it's yeah, both ways as well. This is tough because when it comes to future income, it's all about how stable income is. They are looking for salary or full-time jobs. If you are part-time, like I said, it's never a no by any means. So don't say it's like, it's not gonna work. We also have our TBD scenarios as well, where you can use your partner points just to see if that would be eligible as well before it goes to underwriting. But if you do get an offer letter and it shows variable income, there's a very good possibility that we will not be able to use that future income because how they look at it, they need to make sure it's stable and everything too. So it has to be salary or full time. And if it's part time or less hours like that, the chances are very low.
Well, if it's a 16-hour guarantee, wouldn't be considered as a salary then, right?
No, not in this case. So they'll look at that offer letter as an hourly paying job that is not full time, so less than 40 hours. We will not be able to do that one most likely, but I'm not going to say no because credit policy has pulled their magic before, so there's still
Unless you get a pay stub, maybe. Unless you get a 30-day pay stub, maybe.
You could try to go that route as well, but at that point, it won't be a
Okay.
future income route anymore. It will
Yeah,
just
yeah.
be so you can try to show proof as well. That's full time. We can go that route as well.
Appreciate all the information, man. That
Yeah, of
helps a
course.
lot. Seriously.
Yeah, of course. The one thing I do
Yeah,
want to
no,
touch on too.
this has been great, Top, because I mean, these are just scenarios that come across our desk, and once we start seeing a trend
Yeah.
of things that we're getting hit with variable income, I want to make sure our team is airtight on this stuff here.
100%. Scott, if you don't mind, I just want to say one thing too. I tell my clients as well is that sometime less might be better. Like we get situations, it doesn't have to be income as well, for situations where we have a cash out, for example, and we are getting assets on the file. You are asking for conditions on the file at that point. Sometimes cash outs, they're getting money back, for example. We don't need to show assets at that point. So we provide the assets, for example, they might disclose other things, deductions that are not on there or large deposits. It's good to just do a little bit of a screening just to see what's going on those statements, as well as your income docs as well, just to see. Because obviously once you disclose it to us, we can't unsee it, so we have to condition out for it. So a little screening on that part helps out a lot too. I think the ideal part is trying to make sure that if you get the initial approval, you don't see any senior conditions. That's a golden condition, right? Golden approval right there. We want to finalize the DTI up front. So if you want to look at your pay stubs up front first, see what we need. We do have calculators as well on ease as well that you guys could help. If you guys have any questions, you can plug it in as well. Self-employment pay stubs as well. That could help out because obviously our goal is try to get this TTC as fast as we can as well on this side without conditioning out.
Sorry, we're getting a little bit of a choppy signal here. I did want to touch on that, Top. Can you hear me okay?
Yeah.
Okay. UWM income calculators, should they, if they're sending the loan to UWM, should they be using those? And is that the calculations that you go off of?
Yep, that's the calculation that we go off of with the income calculators, especially like the self-employment files as well. Like those are the calculations that Fannie and Freddie utilizes as well. So we have that as a tool. Obviously, like if you guys are not using it, that's totally fine by any means. We want to help you guys out as well. Just to, you can put it in, you can see it up front as well, what your expected their qualifying income is going to be. So you guys are not blindsided when we do, send out our approvals and whatnot, and we make that conversation.
Perfect.
Yes.
All right, variable income, any other questions, scenarios,
I have a question.
Alvina has one.
If we're using, if a client has a corporation, they're paying themselves out through their corporation with the W-2. I was under the understanding we have to calculate the corporation K-1, in addition to that, we have to calculate the W-2s that they're getting. I heard that we don't. If they qualify based on their W-2s, we can go off their W-2s as long as it's been 24 months.
Wait, sorry, you cut out there. What did you say by chance? Sorry, I heard corporation. It just cut out the signal.
So essentially, there's a borrower, self-employed, been W-2ing themselves for 24 months. Can we just use the W-2s even if they own the corporation, or do we need K-1s plus W-2s?
So in that situation, we can try to look at the W-2s. So just only qualify off of just W-2s in the situation.
Yes.
Yes.
They can on this one. I can look at our guidance right now as well, since I have you.
Please, I have a loan right now that I'm.
Yeah, no worries. No worries. You can yeah, Scott can send over my contact as well. I could just double check for you as well.
Question for you too. Okay, so say that someone has 2 years owning a corporation, 2 years in business as a self-employed person, but they haven't filed this year's tax return. DU is asking for 2 years. So if you have 2 years owning the business, but you don't have 2 years tax returns, can you use that?
That's a tough one, because at that point we would honestly ask you to, like, honestly, we can't really go ask the borrower to do the 2022 tax returns, but the income would essentially be cut in half, because we would have to do a 2-year calculation. We can't go off of 1 year at this point because DU is asking for 2 years. You only have your 2021 returns on file. So when we do the calculation, we would have to ask for 2020. But if they started in 2021, for example, they don't have another year. So at that point, you're going off of whatever they made in 2021 and 2020, which is literally nothing. So you zero out that, and it's not gonna work. So if I was a senior underwriter on that one, I would advise you to resubmit the file once they have the 2022 returns, so you could calculate the income. Or you could try to explore the option of going, well, you actually can't, because it's less than 5 years. So we would have to stay on DU on this one. So we would have to try to get the 2022 returns on this one to qualify.
Okay.
So LP, Freddie Mac, minimum 5 years in business to go off of 1 year self-employed tax return, correct?
Correct.
Now, Fannie Mae, sometimes we are getting results only conditioning for 12 months tax returns with only like 3 years in the business. We're okay on DU on those. What can trigger though, if DU only calls for 12 months, but let's say we're using reserves from business account, there are certain things that can trigger it back to revert back to 24 months, correct?
It can, yep, it can. So obviously, like, sometimes you'll have a 1 year calculation up front when you run AUS. DTI increases, LTV, all those risk factors, all those things can play a factor as well. AUS, when we do run AUS, it takes that to account as well. That's why it spits out the 1 year calculation. If it is not as risky as they think when they run AUS, we can just go off the 1 year calc. But there's nothing that we can override. If you had the 1 year calc previously and all of a sudden it's 2 years now, the best of my ability is, like, let's revert everything back to see if we still get that 1 year back. Let's try to pay off this debt like it was originally, try to get the DTI down, LTV, let's get that down to where it was initially when you had that 1 year calc, and see if it's still spitting out that 1 year. But there's no guarantees that we'll get it back as well, which is the unfortunate part about DU.
Which we submitted, calculated everything on 12 months, certain dynamics on the file was able to trigger it back, then they now called for 24 months, specifically was business assets.
Exactly.
I actually have one more question again. It has to do with this. You just said that you have to wait until you get the 2022 taxes to use the 2 year taxes. If they have 2 years of employment, self-employment, but 1 year taxes, is it possible for DU to actually still spit out 1 year of taxes even if they don't have the 2022s done, or it already knows?
It's possible. It's definitely possible as well. It's all about the risk factor. Like,
that's a risk, though.
Yeah, it's the red. So once you look at it, they probably take that to account as well. That, well, they were only in business for a year and a half, 1 full year that was filed, obviously on the tax returns, but we don't have 2 years
Sure.
filed, so we can't just go off of we can't just condition out for a profit and loss. We need to have 2 years of filed income to the IRS to calculate the 2 year. So at that point, we could try, never say no. So we'll run AUS. Hopefully, DU spits out that 1 year. If not, then we might be screwed.
I'll let you know when I'm the exception to that rule, brother.
All right, let me know. Let me know.
I have another question over here, Alvina.
Okay, corporate taxes. If on corporate taxes, 2020, they had a 1099.
Yes.
2021, they got a W-2. Can I still use the W-2 or do I have to wait for this year's taxes and go W-2 again?
Okay, so they went from self-employment to W-2, correct, on this one?
It's the corporation, they have the K-1 showing, but I was gonna use the K-1, but they're only 50% ownership, so I can only use 50% of the income. Therefore, I was gonna use the W-2, but 1 year is W-2, the other year is 1099.
So,
And amend his taxes, I was gonna wait for this year. What would you recommend? Because the CPA went 1099 W-2.
and they're currently still 50% of that corporation?
Yes.
This is a tough, I would wait on that one. That's a tough one on that one, but I would wait and hold off. Because you have 2021, they were 100%, right? Then
No, 50-50.
50-50 in 2021, then 2022, they went to W-2.
2021, they went W-2 and they're still 50% ownership.
There's still 50% ownership?
Yeah,
Okay,
they had 2 years of 50% ownership, but they paid themselves W-2. So
Okay.
that's 2020 and 2021. 2020, 1099, 2021 W-2.
oh. At this point, we could try, so if we're doing a 2-year calculation on this one, so if it's 1099, 2020, it's gonna be, so when we do, if let's just say we do a 2-year calculation, there is like an add back that we can try to give them as well. We would have to treat this at this point, if it's 50-50, I'll look into your other case as well with the corporation, but for this one at least, you would try to add back the W-2 into the calculation as well. And the 1099, I'm not too sure on that one, so I can't speak to it. I've never had that kind of case before, so I can look in a little bit deeper just to see what we can do. But if we're just going off the most recent 2021 year, they do have the W-2s. That can be an add back to their corporation calculation that they have as well. 50% is what is given to them on the corporation, but the W-2 is a full add back because they earn 100% of that W-2.
Okay, so this year they would go W-2 again, and I can use the full W-2. And if
Yep.
they go 100% on the corporation,
Mhm.
can I use 100% or do I have to use 50-50?
No, you would go up 100% because that will be the most recent filing. So it'll be 100% at that point.
Okay.
Anyone on Zoom want to chime in? Anyone else?
Scott, I could always ask more questions. I got so many of these.
We'll do one more.
All right, last one. If I think my brother was asking me because he's on a 1099 and he went from a W-2 to 1099 or 1099 to W-2 in the same job. Is that an issue as far as for averaging out income, or does he need to have a minimum of X amount of months as a W-2 employee?
Yeah. So how long is he? Let's just say he went to 1099 or a W-2 to 1099?
I want to say he went from 1099 to W-2.
Okay. Let me ask you for the W-2 part at least. Do you know if he's like full time by chance?
Yes.
Or is it he's full time? Okay. Then we're not really going to question as much. Obviously, we'll need to verify. The employer will have to verify that they transition from 1099 to W-2. That's totally fine. And we can just move forward on that route. But if you go the other way, if you go W-2 to 1099, it's pretty much like going the route of not having the full history. So we would need to average the income actually on this one. So if at that point W-2 to self-employed, we need to make sure that the income's stable enough, so we would average the income.
Yeah, it's gonna be the same income. I just think the way he files is just different now, so that wouldn't be an issue then.
No, yeah, especially if your route, at least from what it sounds like, they're going to W-2. It's a lot easier going that route than going the other way, where it's W-2 to self-employment.
Gotcha. Okay.
Yes.
Sounds good. Thank you.
Yeah, of course, Armin.
If you're going W-2, does it have to be the same kind of work?
Yes, it should be in the same line of work on this one, because if you're working W-2 all of a sudden as a loan officer and you're changer to retail, like I don't know, Walmart, for example, it doesn't really make sense at that point. So it should be in the same line of work.
I have a question. Since it's tax time right now, and if we are using 2022 taxes to qualify our borrower,
Mhm.
is the lack of transcript availability going to be like a hard pass at closing?
We always try to explore the route of trying to it waived at CTC. We always at initial underwrite, once we finish the underwrite, we send it to our internal 4506 C team. They're the one who does the order and try to get the tax transcripts. Those order can take as long as 3 to 4 business weeks. So obviously if the borrower can obtain some sort of proof of filing, for example, that will help us a lot. But if that's not the case, we can always try to explore the option of trying to getting it waived. This process, I know it might suck at time because we only do it at CTC on this one, and that's when we send it up to our credit policy and they see if we can try to get it waived. First line of defense is myself first, so we see if we can try to get it waived from my side. If we cannot do it, we send it up to our team to see if we can try to get it waived, or we have to get borrower obtained tax transcripts.
Okay, so you're saying that like proof of just filing the taxes could be in lieu of tax
Yep.
transcripts?
Yep. So there's a lot of routes that you can go. It doesn't have to be tax transcripts. You can try to get stamp returns as well. That's another route.
You get the stuff
Okay.
that they tax money.
Thank you.
You get
Yep.
that
Yep.
one where they get a refund back.
Yeah.
Exactly. So like if they get a refund, like the underwriter should at that point just look at the file. And if they have a refund, you can always go to where's my refund on the IRS website. And if we are able to obtain it matches up exactly, boom, that's perfect. If they owe money, for example, did they already pay it? So we will look at their bank statements just to make sure as well that it's already been deducted. At that point, if it matches up to the tax returns, then we're fine. And that's proof of filing right there.
So yeah, if they're self-employed or something and they owe money and we want to use 2022s, we have to show that it's been paid. They can't even be on a payment plan because if they did, we would need 3 months, correct?
Yep.
So paid in full. So, okay.
But don't have them pay it because by the time that they show it on the system and it has to clear the account, because they do is pay direct. Yeah.
Do you see it paid through escrow more often than paid through the bank account, Top?
We see it more actually in the bank accounts. We don't see as much, like you said, with the escrows, but we actually see it more through bank accounts. That's why we always try to obtain it like that. But there's other ways as well. These are like things that at least UWM have seen that are common. So things that I've named off. There's another document as well. It's called, I think it's 9325 form. Usually the tax preparer CPA fills that out, just confirming that, the taxes have been filled out and filed. So that's another route as well. They fill that out. That's another proof of filing as well that we can
Where
take.
we get that format?
That one, the CPA tax preparer should be the one who fills it out. So they should be the one who have the documentation. Yeah.
Good
So it's
stuff.
like so you see it should be box 1. They check it and they also explain that they filed it, they sign it. We could take that as well.
This is good stuff, guys. We got 5 minutes left because we got to respect Top's time and Jeff too.
Very good.
Amy had a question?
No, I was just gonna say something about paying the taxes that we did. Title has to have it pay off from IRS, so if they're behind and that's not processed, then that's a problem.
Good point.
Oh.
Good point. Yeah, because title, for us to do it through escrow, we'll need some sort of demand from IRS and IRS might be lagging for that demand.
Yeah, we always say too, like from our side, when we try to order it, there's always a delay, especially around these time of years. It's around the tax year, so it's always delayed. So whichever comes in earlier, if the borrower can obtain the tax transcripts, we can take that as well in lieu of when we order it. But there's other routes that we can try to obtain to show proof of filing to like waive that condition.
Good stuff, because we don't want hiccups at CTC.
No, 100%.
Anyone else have any questions for Top here? It's good stuff here, live scenarios.
What about our scenario we had recently? So we had a scenario where the borrower received a recent raise about probably a month ago from like $30 to $35. He was variable. However, I had a payroll ledger along with the written DOE verifying his pay raise date, last effective date. And he averaged 34 hours in 22. So the underwriter at first was kind of penalizing him, wasn't seeing that he wasn't giving him the increased amount and looking at his average hours of 34 hours a week. I submitted a memo and everything, kind of talked to her a couple of different times. We ended up escalating it and we did get somebody reasonable and worked with us and did allow for us to use the increase of $35 an hour.
Yep.
The full ledger justifying his hours average 4 hours a week. So
Yeah.
in a case like that, where we're trying to use a pay increase, we can provide justification, documentation that they are averaging a minimum hours of whatever that average per week, right?
Yeah, of course. So you said this is variable income and they had a pay increase.
Variable.
Is that what it? Okay.
Right, the variable income with the recent pay increase.
Okay. Was it like a year-to-date situation that you had issues with, or what was the pushback on that side? Because when variable income, if the borrower would have like a pay increase, for example, it only affects the trend just a little bit, I guess, but it's more of a big factor when you are salary and for example, their works full-time, 40 hours a week. They got a big increase from, $27 an hour to $35 an hour. That's a pay increase that would actually be beneficial for the file. When it comes to variable income, maybe $1 or $2, it only would fluctuate the year-to-date amount, I guess, because if it only changes quite recently, it's only changing the trend by a couple of, maybe a couple $100 or and whatnot. Because when you do the trend, you're not really going off of the pay rate, you're going off the year-to-date amount. So that's probably why there was a little bit of pushback there. But how I look at it, it's going to help your cause, obviously, if they did get a pay increase, but it's only going to fluctuate just a little bit with the year-to-date, because it doesn't go off when we do the trend. We don't go off of the pay rate when we do the variable income calculation. We just look at the year-to-date and we just trend off the year-to-date.
I think there was like the $40 that we needed.
Yeah.
Yeah, exactly. It helps though.
All right, guys, are we,
Sometimes,
one last one with Ulyss.
I know sometimes like with like drivers and delivery drivers, they have other, other categorical parts of their pay other than just, overtime or commission, stuff like that. Insight on how to best prepare that, especially where I've run into it once before where the company even basically changed the name of these different pays. And that was a real hurdle to try and overcome. So when you guys see something like that, with like especially drivers, you see other forms of income, but it's part of their stable pay. How do we, broach that when we are somebody go up?
Yeah, so at least for your case, at least, was there like multiple like pay stubs that were provided that show like fluctuation in hours and pay as well?
Yeah, I think we showed like all pay stubs for the last 12 months in that scenario, just to really kind of show that it was, we could show a strong trend, and then we had to go back and get a letter of explanation from the employer too, just to kind of verify that, this pay is the same as this other one. They just changed the names because they changed like HR companies basically.
Yeah, that's totally fine. Like that was perfect, because obviously it might cause a little confusion with like the name change and whatnot, but usually when it comes to drivers, they are variable. The per diems, I believe, if I'm not mistaken, that's what they get paid out by how many miles they drive. So in that situation, all depends case by case. I've had situations where we just trend everything on that pay stub. We treat it like union pay. If you have union workers as well, typically union workers are considered variable pay. with a caveat of obviously if they've been there for quite some time, they show consistency of 40 hours, we go off of full-time pay, but that's the same thing that we would just go off of just trending the income.
Awesome. All right, this has been pretty awesome top. I know, we gained a lot of value out of this thing here. A lot of different scenarios. Sorry to throw so much at you, but we learned
Good
so
job.
much today, and it's just gonna help us, cleaner, faster, and better files that come in and out.
Appreciate it. Thank you so much for having me, Scott.
All right, thank you, Jeff. Thank you, everyone on Zoom. Appreciate it. That was another good meeting. It's 12 o'clock.